So Macquarie Group is our stock of the day. It's posted its second biggest annual profit on record, boosted by strong growth in its commodities and markets divisions. Net profit up by 1/3 to $4.85 billion. That's up from $3.72 billion the same time a year ago. It's made gains from the divestment of its on-stream meters platform and high risk management income and performance fees as well. And the company says it remains well positioned to deliver superior performance in the medium term, and it will pay a final dividend of $4.20 a share. That's up from $3.90 a year ago. We don't have our usual charts to call on today, but that's certainly a one day. Is that a one day? Yeah, because we need to. There we go. We can see what has happened just over the past couple of hours. There's the 1 year chart. And Jonathan, what did you make of that result? And I guess what is ahead for Macquarie, given particularly it's so diversified as well?
Yeah, absolutely. So I flagged this to my clients as a trade at the start of earnings season for the US. So the US banks all reported record trading volumes and profits amongst them. And I was like, well, who's the biggest and best that we have here in that space? And it's Macquarie. So Macquarie broke out to new highs. I jumped on board, and then I knew the earnings was coming in today, and I was like, I'm going to use this as exit liquidity. So that was the trade, and that was the play. But just in general, Macquarie, great company. They're the number ones in cash management accounts. We use them. We use them for structured products, fixed coupon notes, things like that. So great diversified business. And they're great at trading. And I think that there's going to be more profit to come within commodities over the next few years. So I wouldn't buy just here at the moment. Looks like there's a bit of a shaking the tree. Then there should be a dip coming over the next few days. And I would buy that. But just in general, like longer term, I think it heads on higher. And we are in the right market conditions for it to continue to keep making those big profits within the commodities trading. And then they've got that solid cash management account, and they're building that to buffer up their mortgage business as well. So yeah, it's a buy in general, but I wouldn't buy it here today.
Yeah,
just wait for an entry point over the next few days.
I'll take that as a hold then for longer term. But so what you actually sold just prior to this result?
Yeah. I just use as you know, I'm a shorter term trader. Okay, so I was in for, I forget the exact levels, maybe about the 220, but I used a bit of leverage on the trade, so it hits my target. I knew that the results were going to be good, but I just know the Australian market, when stocks break out the new highs, someone comes in and just smacks it on the head. So I just knew that, and that's from experience. So I just knew to take that high print on the open. If it runs away with you, you can always jump on board. But I usually find that there's that morning print on good news, take that and reassess, and that's what happened today.
Well, Andrew, of course, you are a long-term holder. So does Macquarie make the cut for you?
No, it's funny. We were on Wealthy and Wise episode 9, which was about 4 weeks ago now with Nadine, and Macquarie came up. And the question was actually, the viewer question was a really interesting one because it was around how do we see as long-term Teaminvest investors all the big banks and then Macquarie specifically. And I won't go into too much detail because you can catch up, of course, on ausbiz website and watch that episode at any stage. But we talked about the fact that there were really 4 key reasons why, as long-term value investors, the banks as a whole are not particularly exciting to us. And they come down, all of them, to the reason that they're far riskier under the surface for an equity investor than at first they appear. The first is that the nature of the business model converts short-term liabilities into long-term assets. And so that's fine when things are steady and normal, but anytime the economy or the world goes through a bit of an exogenous shock, big changes, they become overly exposed if they got it wrong. The second is they have, all the Australian banks at least, have an existential reliance on offshore wholesale money markets. And we saw that in 2009, we saw it in 93, we saw it in the 80s. If wholesale global money markets close, and they do close about once every 10, 15 years, we are particularly exposed because there is no domestic corporate bond sector to pick up the slack. The third is that there's an increasing trend towards taking on riskier and riskier lending by all of the Australian big banks, particularly as a result of the rising Australian property market and government intervention that has reduced the requirement for deposits and security in order to encourage people to get into homes. You know, it used to be a 20% minimum deposit, then it got to 10, now it's 5 if you're a first home buyer. And that means that if anything happens to the Australian property market, our banks are going to be particularly exposed. And then lastly, all banks in general globally are extremely exposed to volatility in earnings from changes in inflation, economic growth and interest rates. And I think you'd have to say that we have been through a period of very steady inflation, economic growth and interest rates for the last 10, 15 years, but that's probably not the coming years ahead, at least while Trump remains in the White House and everything continues. So as a result, nothing has changed since that episode. This was a great result from Macquarie, but the iceberg hasn't gone away. So if you're in it, maybe hold, but I wouldn't be looking to buy it. And personally, I wouldn't own any of the banks. We'll talk about that later.
Yeah, we will indeed. All right, so we'll take that as a double hold, albeit a weak one from Andrew. That is our stock of the day, Macquarie Group.